Hello there, investorholics and casual viewers and friends. Welcome back to another ETF Spotlight review. Today we're going to take a look at MVA, which is a VanEck Vectors Australia Property ETF. So this ETF might be suitable for investors seeking exposure to a diversified portfolio of global infrastructure equities in sectors such as commercial, retail, office, and specialised and industrial property. They have the potential to generate a regular income stream from a reliable, stable dividend payouts. So just a quick one for those who forgot what a REIT is. So a real estate investment trust are listed vehicles that own and operate property, mainly collecting rent, not running a business. So they just maintain the building. REITs are required to pass income through to investors, not retain it, so they have to pay out 100% of all income profit. REITs are not companies. They do not pay company tax, and distributions are not franked. The sector is traditionally susceptible, if I can get that out, to sharp interest rate rises and economic slowdowns, or rising competition. So while REITs can be a good source of income, the sector's growth characteristics mean individuals need to take a long-term view, and that's particularly why I like to actually buy ETFs that cover pretty much all REITs, so it'll kind of balance itself out in the long run. Hey there, investorholics. This is Scott. KrackTheSky Value Investing will be giving you up-to-date investing news and content so that you can navigate the markets wherever you are. My mission here at KrackTheSky is to give you the knowledge and the confidence to take control of your personal finances, expand your investment horizons, and crack your financial sky. So don't be afraid to give me a thumbs up and also subscribe. It helps get the message out there. It helps pump the algorithm for YouTube. Just in general, it sort of gives me a bit more motivation as well to keep doing these little reviews for you guys. Thanks. Okay, let's dive right in. Investment objective. MVA gives investors exposure to a diversified portfolio of ASX-listed securities with the aim of providing investment returns before fees and other costs that closely track the index. Okay, a little bit more about the index. So it's the MVIS Australia A-REITs Index. It's a pure play, rules-based Australian sector index designed to capture the performance of the property sector of the Australian economy. The index tracks the performance of the largest and most liquid ASX-listed real estate investment trusts, A-REITs. Management style, it's a full replication, so they just buy whatever's in the index. Why factor? Why do we bother with it? So Australian real estate investment trusts invest in an investment portfolio of Australian real estate, providing exposure to commercial, retail, office, and specialised industrial property in a single trade on the ASX. Efficient access to property investing with low entry costs. So liquid form of bricks and mortar with low capital commitment compared to buying real estate directly. So effectively, this is another way to actually get access to real estate. There's multiple ways. This is just one more way to get some exposure to real estate. Relatively high and stable yields. The A-REITs, Australian real estate investment trusts, generally pay more dependable and higher distributions than other Australian listed companies because they have to pay out all of their profits. Okay, let's look at some numbers. So we had a net asset value of $21.38, trading just above that when I put this presentation together at $21.43. Market cap of this ETF is $474 million. Management costs per annum or per year is 0.35%. Very reasonable, very competitive. You get a distribution from this ETF twice yearly, so in January and July. Yield is probably one of the better ones at the moment, 4.85%. So VanEck Vectors Australia Property ETF is a compelling choice for Australian REIT exposure, thanks to its attractive costs and the unique diversification offered. The Australian REIT sector is small, with just 49 listings on the ASX as of middle of last year. I don't think it would have changed any time. Oh, maybe there's 50. There was a new float at the middle of last year. Some of the old masters or whatever they were, those ones, after they were bought out, they were refloated middle of last year. So the traditional index, like the S&P ASX 200 A-REIT, magnifies this concentration by market cap weighting, its constituents, leading to a sizable stock and subsector skew. So individual index components are determined using a stringent rule-based methodology focused on liquidity with a minimum of 10 holdings. This is MVA. So each with a maximum weighting of 10%. So that's kind of the difference between MVA and say SLF or VAP. They pretty much don't follow that type of equal weighting. So you'll see some of the constituents up to 20% of the actual index. So that's kind of where it skews. Yeah, so that's kind of what I was touching on here. So MVA's strategy weights its stocks more evenly, capping the top 7 individual stocks generally at no higher than 10% of the overall fund. So MVA is different to the other ones. The other pure play passive ETFs with a smaller portfolio size that covers approximately 90% of the index. Its slightly more active strategy reduces concentration in the largest names, besides negatively screening small end of the market cap spectrum. So it tries to flatten out the top and screen out the bottom end to increase the quality of the holdings. As mentioned, have a look at SLF and VAP, worthy contenders for an investment as well. Okay, so as we sort of touched on before, you can see the percentages of the top companies in the index, and there's sort of nothing really over 10%, 10.5% type thing, which is S Centers Group. Total return since inception per annum, you're looking at 10.89%, which is pretty solid. You can see the graph down there, that just sort of shows you how it's been tracking net asset value since inception anyway, and sort of how that marries up with the S&P ASX 200 A-REIT index. So pretty much you're looking at the companies that it holds, pretty much all the usual suspects, I should say. Ascena, Stockland, Dexus, GPT Group, Goodman, Mirvac, Charter Hall, Vicinity, Charter Hall, Long Whale REIT, Shopping Centres Australasia, BWP, National Storage, Waypoint REIT, Cromwell, and Abacus. So you look at any of the other property ETFs, and they'll all have those in there as well. So MVA's distinct composition has resulted in category relative outperformance since inception through to middle of last year, attributed mostly to the small and mid cap rally over the large caps during the same period. So pretty much the smaller end of the market has probably performed better than the top end. Sort of the more equal weighting will actually reflect that, which is a bit not quite as obvious when you're dealing with, say, SLF or VAP, because they're more top heavy. So the bigger property trusts have a higher percentage in the ETF. So VanEck Vectors Australia Property ETF, underpinned by a sound index construction, strong indexing capabilities. Fees are pretty good, so the management fee is pretty good. So it should, as I sort of touched on earlier, should be good for someone with a long-term investment horizon. So Morningstar have given this ETF a bronze rating. So that's effectively 3 out of 5 stars. So it's a solid option if you're looking for exposure to the Australian real estate investment trust landscape. Do I own it? No, because you can only own so many of these things, and I own 2 of the others. So I own SLF and VAP. But whether you substituted MVA for SLF or whatever, I don't think it really makes too much difference. I think they're all reasonable options, but as always, complete your research, and if required, speak to a financial advisor or a professional. I'm not a professional, this is just telling you guys what I do. Are you interested in learning more about personal finance and investing in the markets? If you are, then smash the like here on the left hand side and caress the subscribe button on the right hand side. It's KrackTheSky Value Investing. We'll be giving you up-to-date investing news and content so you can navigate the markets wherever you are. Expand your investment horizon and crack your financial sky. Thanks guys. See you later.